Today, we're going over the truth about hard money loans for beginners, and we're going to drop the 100% fix and flip financing cheat code. So, not just how they work in theory, but what they actually cost, where investors get caught out, and the one funding gap that kills deals before they even get to the closing. Whether you've never done a flip or you've done a handful and want to tighten up your funding, this is worth your time. So, let's get in. So, what is a fix and flip loan? At its simplest, it's a short-term bridge loan. We're talking 6 to 12 months. You use it to acquire a distressed property, fund the renovation, and then either sell it on the open market or refinance it into a long-term hold. So these are not 30-year loans. They're not conventional financing. They're designed to move fast and get you from acquisition to exit as efficiently as possible. So it's asset-based, a W-2. They're looking at the deal itself, the property, the numbers, the plan. What's the property worth today, the starting point, and they're going to see the AB or after repair value, the ARV. What will the property actually be worth once you're done with it, done with the renovation? So taking into account the rehab costs, how much does the renovation actually cost, scoped line by line, what's your exit strategy, how are you getting out, sell on the market, refinance or hold, and the lender needs to know all of that. You get those four things right and the loan's pretty straightforward, so get them wrong and the lender won't touch it. So what does it cover and what does it actually cost to get into a deal? So a good hard money loan covers two things, the purchase price and the rehab budget, up to 85 to 90% of the purchase price. Some lenders do 100% of the rehab budget on solid deals, 200 grand purchase and a 50K rehab. The lender funds 170K, which is 85%, plus the 50K rehab. So they're giving you 220 total financing. You bring 30 grand down payment plus closing costs. So what you also got to take into consideration is they'll have origination points. So hard money lenders will charge 1.5 to 3% on a standard single family flip. So on 220K from our example, at 2 points, you're paying 4,400 in origination fees. Interest-only loans running from 8 to 15% depending on the project, lender and borrower profile. So this is your holding costs. You're paying these each month. And then your loan terms. So 6 months is most common, 12 months widely available. Extensions possible, usually for an additional fee or a point on the loan amount. So these loans cost more than a conventional mortgage because the lender's taking on significantly more risk, funding most of the purchase and all of the rehab on an unfinished property. That risk premium is what you're paying for, and if the deal is structured correctly, it shouldn't affect your profit meaningfully because you're in and out. Now, this is where a lot of people get stuck halfway through. Let's look at how the rehab draw process works. This is the part that catches investors off guard and it affects the cash flow through the whole project. When the lender funds your project, your rehab budget, they don't just hand you 50 grand and say good luck. They put it in an escrow account and release it in draws as you complete the work. So you have to float that first stage of the project. So complete the work, finish the contracted rehab item, whether that's the foundation, getting the roof on. You submit that stage, send requests with photos, or they might come out and actually inspect the property to make sure the stage is done. Once the lender verifies, the underwriter or inspector confirms, then they'll release the draw. So the cash will be dispersed in 5 to 7 business days. This is the critical cash flow problem. You have to complete the work before you get paid for it. So your concrete crew, for example, needs paying before they'll pour the foundation. Your framing crew needs paying before they'll put up the walls. And materials need to be on site before you can start. So that gap between when you spend the money and when the draw comes back can be 10K, 20K, 30K at times. So if you're not prepared for it, it stalls the project. This is what we really deal with every day of the week at GapFunded.com. We help clients set up working capital lines specifically for bridging draw gaps. Business credit cards with 0% introductory period work very well here to pay the contractor, submit the draw, get funded, clear the card, move to the next phase. Now, there are ways to liquidate credit limits into cash you can actually use to pay contractors, use to pay for materials, even down payments and closing costs. So the zero interest cost, if you're working within that 0% window, typically 12 to 18 months, we structure this as part of the overall capital stack. Not halfway through when you're already stuck, even though we can move fast on this. It's good to have it prepared and ready before you get in. So who qualifies? Because hard money is an asset-based lending, the deal matters more than your resume, but your borrower profile still shapes the terms you'll get. So for experienced flippers, investors with multiple projects in the last 3 years get the best terms, lower points, better rates, faster approvals. Lenders look at recent history specifically. So 3 projects in the last 2 years carries far more weight than a flip from 12 years ago. They want to know you can actually execute. For first-time flippers, you can still get these loans. The deal matters more than your resume, but expect terms to be a little less favorable on your first 1 or 2. Higher rate, maybe an extra point. That's the risk premium for being an unknown quantity. Do a few deals cleanly and terms will come down. So Contractors is an underrated group here. Contractors doing their own flips has 2 big advantages. Obviously, lower labor costs because they have crews, lower material costs of trade prices, and a contractor who understands the rehab cost structure deeply is often seen as a better risk than experienced investor who outsources everything. So the common thread across all 3, just to recap, is come to lender with a proper scope of work, line items, rough cost estimates, a realistic timeline, and a clear exit strategy. And that document tells the lender you understand what you're getting into. So this is the funding gap that nobody talks about. This is for beginners all the way through to experienced investors. Your hard money loan covers 85% of the purchase. If you're lucky, 100% of the rehab. That leaves a gap. On a 200K purchase, 85% is 170 grand, meaning 30 grand down. And that's just the down payment. Add closing costs, points, title, insurance, legal fees. You're often looking at 40 to 50K cash required just to get to closing before the project's even started. So the expensive way to solve this problem is some investors bring private equity partners, but handing someone 30 to 40% of your profit just to cover down payment is an expensive capital move. On a deal with 60K net profit, that's 18 to 24K of your profit just gone right there at the closing table. Here's another way to do it, the GapFunded approach. We help clients fill that gap with structured capital that doesn't cost them equity. So gap funding is a short-term credit-based capital at a fixed rate, 20 to 120K deployed in 24 to 72 hours. No equity split, no partner, no early payment penalty, and I should say no convincing the seller to do seller finance or sub 2, which is 1 in a million. Unless you do wholesale full-time, I wouldn't rely on that. We do 0% credit stacking. Where appropriate, we build a business credit card stack that covers the down payment at 0 interest for 12 to 21 months. Doesn't affect your personal credit profile, so you can max these out and then pay them down once you've pulled your profit out. Repaid from the sale proceeds, as it says there. We also do the HELOC strategy for established investors or people that own their own property. A HELOC turns that idle equity into a revolving line they can draw from deal to deal. So it's like a credit card backed by your property. And people typically see anywhere from 8 to 15% interest on those. The funding gap's a solvable problem. You don't have to hand away 40% of your upside or pass on deals because the last mile of capital isn't funded. So let's go over a quick deal example here. A Detroit duplex. Purchase price 92K, rehab budget 55K, including 10% contingency, total financing 133 grand rehab, and then we got a 12% interest rate, interest only. So let's look at the exit strategy. The area has a very strong Section 8 HUD rents. Each unit pulls around 1.4K a month from HUD. That's 2.8K a month on a duplex on 147K all-in investment. So the exit then is to refinance out of the hard money loan once the project's done into a 30-year non-owner occupied DSCR loan. Once the properties are stabilized and the Section 8 tenants in place, this will give a strong cash flow, long-term hold, and it's done. This is why your exit strategy matters. It's not always sell on the market. Sometimes a deal works better as a refinance and hold. Sometimes as a medium-term rental, have the exit mapped out before you close, and have a backup exit if the primary one doesn't go to plan as well. Let's look at some of the common pitfalls of a fix and flip. So underestimating the rehab costs, having your capital stack in place before you go in. It's very easy to underestimate what a renovation actually costs, especially without established contractor relationships. So always build a 10% contingency into your rehab budget, always, and then assume you'll use it. Appliances that look fine won't work. There's a leak in the roof you didn't see on the walkthrough, or the sewer line needs work. Something will come up. The contractor timelines blow out. A contractor might tell you 4 weeks to get the job, takes 3 months. This happens constantly. Permitting delays, through availability, one trade holding up another. Get multiple quotes, ask for references, ask to see completed projects and how long they took, and ask directly, are you actually available to take on this project right now? A busy contractor with 5 other jobs won't prioritize yours when something slips. So the third one's the market timing. This is more about the exit strategy and the value holding as you go through the project. So the fix and flip market doesn't move fast. It's like a cruise ship, not a rowboat, slow to change direction. If the market starts softening mid-rehab, your exit gets harder. Know what average days on the market look like in your area. And if comparable properties are sitting for 90 days, don't model a 3-week sale. Homes only fail to sell for 2 reasons, price or condition. You can't control condition with the flip, price, undershoot the rehab quality. Those are the things within your control. If you're ready to fund your next deal, get pumping. Fix and flip loans work. They're one of the most powerful tools in real estate investing when the deal's structured correctly and the rehab is properly scoped, the exit's realistic. Now, if you need help covering the down payment gap, the draw bridging, so that time between finishing stages, paying contractors and materials, and actually getting it approved as a completed stage, or the full capital stack, we work with first-time flippers, experienced investors and contractors. If you're looking at a deal and you're not sure how to fund the gap between what the lender will give you for a hard money and what you actually need to close, that's exactly what we do. So get a free deal review, link in the description. We'll look at your deal, your credit profile and your funding situation, map out the right capital stack for your specific project. No commitment, no pressure. Drop a comment below with any questions about hard money loans. And a new video every single weekday.